Hey guys, hope you are all having a great day. Today we saw markets rally extend to a fourth day in a row. The S&P 500 and Nasdaq made serious gains as investors were assessing the talks and progress between President Biden and China's Xi Jinping over the Ukraine crisis. The surge was so bullish this week that it actually is the best performing week since November of 2020. We got a couple of things to go over really quick, but before we start, let me quickly state that I am not a financial advisor, and that all content discussed in this channel is simply information gathered that I deem important for people to know, so that they can make informed decisions. All efforts are aimed to better understand the nature of the current market in anticipation of the greatest squeeze in financial history. Let's dive right in. So a lot of people have been asking me what I think about markets, if we are past the bottom and all that awaits us are green rallies, or if these recent runs are a last breath before markets pull the rugs and everything falls back red again. It is hard to answer this with any amount of conviction and certainty, so instead I want to give a bit of a real analysis from various sources using real data and then let you make up your mind. Michael Kramer, not related to Jim Cramer, made some interesting points. The market has been performing very bullish on the charts. We have enjoyed 4 days of pure green performance on the Nasdaq and SPY after all. GME and AMC have been recovering as well. However, it is once you get past the charts and look deeper into Nasdaq or the New York Stock Exchange that you see the profound stark difference in performance. The candles are green, but internally, things are really ugly. A dangerous number of important stocks are making new lows, outpacing those making new highs regularly too. As for liquidity, things are looking bearish. The liquidity in the S&P 500 futures is currently sitting at its thinnest levels it has been since the pandemic began, while the spread between the bids and the asks continue to expand. The top of the book on this benchmark's futures actually narrowed to its worst levels since the start of the pandemic, with fewer shares available to buy or sell on the bid and ask. This makes it a more volatile marketplace and allows futures to make big moves with seemingly no volume, something which has been highlighted as happening in these last couple trading sessions. We talked about the bid and the ask spread widening to some of its higher levels since the pandemic began. This is not a good thing because it means the costs for trading rise, which means traders that are buying or selling get fewer shares at a given price but at wider spreads, creating a very volatile marketplace as prices need to move more in order to fill. On top of this, we also have to contend with the highest levels of inflation we have seen in 40 years. On top of this, we also have US yield curves flattening down to within touching distance of a 2-year low on Thursday. Growth forecasts have been trimmed as well. For those that don't know, the yield curve is a very important metric for investors to keep track of because it impacts other asset prices, it feeds through to banks' returns and is used as an assessor of how the economy will perform. When this yield flattens, it reflects that investors worry whether the Fed can tighten monetary policy in time to combat inflation without hurting economic growth, which, as we already know, is not the case. Yields on short-term US government debt have been rising quickly this year, while longer-dated government bond yields have moved at a slower pace with concerns that policy tightening will hurt the economy. Because of this, the US yield curve has been flattening. Many investors are now beginning to think that the short-term yields will be higher than the long-term yields, which is a sign of bad things to come. This inversion happened in 1955, followed by a recession 6 and 24 months later. It happened pretty much right before a big recession took place. The last time it happened was in 2019, and the next year we experienced a recession. As you can see, when looking beyond a graph at the key metrics of real economic performance, things look like ugly. This is the case to be bearish. Now, the case for bulls lies with the belief that the economy was performing well all the way until November of last year. The belief is that the rate hikes have been priced in, and that investors will be able to quickly adapt to a volatile market and move upwards. Mortgage rates climbed over 4% since 2019 as well. But the biggest case they have is a bullish Jerome Powell. The Fed chair said that the United States economy is strong enough to withstand higher rates, and there is economic data that continues to show strength, with a tight and strong labor market. The bond market suggests weaker growth ahead, but bulls believe that a recession, if it comes, is still years away and that we have room upwards to move before we face a recession. Let me know what you guys feel like the market will perform in the coming weeks. Let's now talk about today. The Fed submitted over $1.715 trillion in reverse repo operations today. Dark pool trades for AMC accounted for 50% of the total volume today, while dark pool trades for GameStop accounted for 53% of the total volume today. AMC had a larger amount of buy orders than sell orders, with GameStop also having a larger amount of buy orders than sell orders. Now, let's talk about performance. AMC had a bullish day, gaining over 4% for the day. It began trading fairly bullish during the pre-market, staying above the VWAP for the most part. Upon market open, AMC began running up, moving past 15.80. After a quick dip, it bounced up and stayed above the VWAP, seemingly trying to surpass its previous high. It failed to do so, quickly dipping underneath the VWAP one more time. However, within a couple minutes, AMC shot up, closing at 15.80, above the VWAP. It was a very weird trading session, but a very bullish one at that. I will make a video on Sunday talking about where I think we might be headed to next week. GameStop had a bullish day, gaining over 3%. The stock opened and shot up from 79 over 94. It consolidated for a while, slowly building up until it broke past 94 again, this time reaching a high of 97.45. Shorters quickly came to attack it, bringing it down to 90.79, above the VWAP. Like I said, I will make a video on Sunday talking about where I think we might be headed to next week. And that is all I have for you guys today. Thank you all so very much for making it to the end of the video. Let me know your thoughts down in the comments below. And most importantly, remember to come join my Discord. If you want to support this channel, I have a Patreon link in the description as well as some one-time donation links for Cash App and PayPal. Thank you again for being a part of this channel. I will continue striving for better content. Enjoy the rest of your day, keep on buying the dip and to the moon.